1.5 times leverage. The words alone are enough to make conservative investors close the tab immediately. The moment most people hear the word leverage in the context of an ETF, they picture the horror stories, the daily reset products that decay into nothing over time. The 2 times and 3 times leveraged funds that look incredible on the way up and absolutely catastrophic on the way down. The products that were designed for day traders and somehow ended up in long-term retirement accounts where they destroyed years of carefully built savings in a single bad week. The funds that promised amplified returns and delivered amplified losses to people who did not fully understand what they owned. So when NEOS launched XSPI and XQQI with 1.5 times leverage, most investors put them in that same mental bucket without a second thought and moved on. But what if that comparison is completely wrong? What if the leverage inside these boosted series products is structurally different from everything else you have ever encountered in the leveraged ETF space? What if the covered call overlay built directly into the fund's architecture actually reduces the effective volatility of that leverage in a way that most people are not accounting for when they evaluate these products? And what if for the right investor at the right portfolio allocation size, this could genuinely be one of the most compelling combinations of monthly income generation and long-term upside participation available anywhere in the ETF market right now? Today we are going to find out. We sat down with Troy Cates, co-founder and managing partner at NEOS Investments, and got every answer to every question that matters about XSPI and XQQI. By the end of this video, you are going to understand exactly how these funds are constructed, why they have been outperforming since launch, what the risk profile actually looks like across every kind of market environment, how the tax structure works in detail, and whether the boosted series deserves a meaningful place in your income portfolio. Let us get into it. Welcome back to the Dividend Desk, where we build income strategies designed for real life and real people. Before we go any further, the important and necessary reminder: this content is for educational and informational purposes only. It is not financial advice. I am not a financial advisor. All investments carry risk, including the potential loss of your entire capital. Please always do your own research and consult a qualified financial professional before making any investment decisions whatsoever. Now let us start from the very foundation because, honestly, understanding what XSPI and XQQI actually are requires first understanding what they are built on top of. If you are already familiar with SPYI and QQQI, you already understand the structural foundation. SPYI holds every single one of the 500-plus names in the S&P 500 without self-selecting or excluding anything from the index, and writes out of the money index call options on top of those holdings to generate monthly premium income. QQQI does the exact same thing, but tracks the NASDAQ 100 instead. Both funds use index options rather than equity-linked notes or individual stock options, which is a critical structural decision, because index options qualify as 1256 contracts under the U.S. tax code, giving them access to a favorable 60-40 split between long-term and short-term capital gains treatment, regardless of holding period. This index option structure also creates the conditions for distributions to be partially or fully classified as return of capital, which defers the tax liability for investors in taxable brokerage accounts, rather than generating an immediate ordinary income tax bill. The core funds are income vehicles first and foremost. They are designed to generate consistent and reliable monthly distributions, while maintaining full exposure to their underlying indices and participating in a meaningful portion of the upside when markets move higher. XSPI and XQQI take that exact same structural foundation and add one carefully considered additional layer: 1.5 times notional leverage on the long side. The underlying holdings are identical to the core products. XSPI holds all 500-plus S&P 500 names with identical weighting. XQQI holds the entire NASDAQ 100. The covered call overlay is the same, but to achieve that additional long exposure, NEOS does something that fundamentally distinguishes these boosted products from virtually every other leveraged ETF currently available in the market. They construct the synthetic long position entirely from index options using a put-call combo, buying a call and selling a put at the same strike price and the same expiration date, rather than using a total return swap or a futures contract to achieve the leverage. And on top of that synthetic long, they add additional short calls at those same strikes to generate the extra option premium that funds the higher monthly distribution. That decision to build the leverage framework entirely within the index options market, rather than introducing swaps or futures, is the most consequential structural choice in the entire design of these products, and it has implications that flow through every other dimension of how XSPI and XQQI behave. So, why does that structural choice matter so much? Troy gives 3 clear reasons during our conversation, and honestly, each one deserves some careful attention. The first is tax efficiency, and it's probably the most immediately important for income investors in taxable brokerage accounts. Index options on the S&P 500 and NASDAQ 100 qualify as 1256 contracts, which means they get that favorable 60-40 long-term, short-term capital gains treatment no matter how long they're held before being closed or rolled. Total return swaps, on the other hand, do not receive 1256 treatment. Swaps usually generate ordinary income, and that's the least tax-efficient category for most investors, which would seriously erode the after-tax return of the distribution income. By keeping the leverage layer inside the options market, NEOS preserves the tax efficiency that's become one of the central value propositions of their whole product lineup. The second reason is operational alignment with their core expertise. NEOS has spent well over a decade building deep expertise specifically in trading index option portfolios. The entire infrastructure, the risk management framework, the rules-based strategy, and the trading desk operation is all built around options on major indices. The Boosted series lets them apply that same institutional-grade expertise to the leverage layer, without introducing an entirely different instrument type that would need a fundamentally different trading approach and risk management system. The third reason is arguably the most important for long-term investors, and it's the reason why XSPI and XQQI are fundamentally different from the leveraged ETFs that have historically destroyed wealth for uninformed retail investors. These products don't use daily leverage rebalancing. Instead, the synthetic long position is rolled on a monthly to quarterly basis, rather than being reset every single trading day. Daily rebalancing is actually the mechanism that causes conventional leveraged ETFs to decay over time in volatile, sideways markets. It's a mathematical reality called volatility decay, or sometimes beta slippage, that can work in your portfolio's favor in strongly trending markets, but really eats away at your capital in choppy, sideways environments. By avoiding daily resets, NEOS has built these products for investors who are expressing a longer-term directional view on the underlying market, rather than just making a single-day tactical bet. That distinction alone separates XSPI and XQQI from the vast majority of leverage products available today. Okay, so now let us get into the distribution rate in real detail because honestly, for income investors this is where the conversation becomes most practically relevant. The core SPYI targets an annual distribution rate of 10 to 12%. The core QQQI targets 12 to 15% annually. The boosted XSPI targets 15 to 18% on an annualized basis, and the boosted XQQI targets a proportionally higher range, in line with the 1.5 times structure applied to the core QQQI range. So, where does that additional income come from beyond what the core products already generate? Well, it comes from the additional short calls that NEOS layers on top of the existing covered call overlay, specifically to account for the extra long notional exposure created by the synthetic long position. When they add the synthetic long, they simultaneously add short calls at the same strikes already being sold on the core covered call positions. Those additional short calls generate additional option premium, which flows through to shareholders as a higher monthly distribution on top of what the core product already pays. The income is not manufactured from thin air, and, it is not funded by returning principal. It is generated from additional option premium that is collected as a direct result of the additional structural complexity of the boosted product. That is an important distinction from the bad return of capital products that older generation covered call funds used, where they paid out more than they earned and quietly destroyed NAV in the process. One of the most important conceptual points Troy makes is about how NEOS thinks about distribution rates at the fund level. Rather than targeting a fixed cents per share distribution each month, NEOS targets a percentage of the fund's net asset value. If the fund is worth $100 million and generates 1% in premium income for the month, the distribution is $1 million. If the market sells off and the fund drops to $90 million and generates the same 1% in premium, the distribution for that month is $900,000, lower in dollar terms, lower in cents per share, but identical in percentage terms relative to what the fund actually earned. This is a structurally healthier and honestly more honest approach to income distribution than the fixed per share model used by legacy covered call funds. Now let us have the genuinely honest risk conversation, because this is where the boosted series differs materially from the core products and where investors really need to think carefully before allocating. Troy breaks down the expected behavior of XSPI and XQQI across three distinct market environments. In a flat market, where the underlying index moves sideways, both XSPI and XQQI should outperform both the raw underlying index and the core covered call products. In a rising market, the picture is more nuanced. XSPI and XQQI should outperform the core SPYI and QQQI because the 1.5 times long exposure participates more aggressively in the upward move. Whether they outperform the raw underlying index depends on how aggressively the market rallies. If the market makes an extremely rapid and dramatic move higher, the short call caps may trim some of that upside. But over longer time horizons, Troy and the NEOS team believe the boosted products are positioned to at minimum match and in many cycles meaningfully exceed the total return of the underlying reference asset. In a significantly downward trending market, this is where the honest risk conversation must happen directly and, without softening the message. The core SPYI and QQQI have a natural buffer in a down market. The premium income collected each month provides a partial cushion. The boosted products have that same premium cushion, but they also carry 1.5 times the long exposure on the equity side. That means in a significant or severe market downturn, XSPI and XQQI will not only underperform the core products, but could actually underperform the raw underlying index itself. The leverage amplifies losses on the downside just as it amplifies gains on the upside. Troy states this directly and without ambiguity. Investors need to understand that leverage works both ways, and the boosted series is designed specifically for investors who have a genuine longer-term bullish conviction and who are prepared to accept and absorb more volatility. Warning: leverage amplifies downside. Here is the piece of nuance that most people miss and that honestly changes the entire risk conversation about XSPI and XQQI. The covered call overlay on these boosted products actually reduces the effective volatility of the leverage relative to a conventional leverage product with no income overlay. If you compared XSPI to a hypothetical product that was simply 1.5 times long the S&P 500 with no options overlay, the NEOS product would have measurably lower volatility. The short calls create a partial cap on upside movement, which dampens the swings in the fund's value in strongly rising markets. The premium income collected provides a consistent monthly buffer that reduces the net loss in down markets. The result is a leveraged product that genuinely behaves less aggressively than its nominal leverage ratio would suggest. Troy addresses the monthly 19A1 notices that appear on the NEOS website with important clarity. These notices estimate the potential return of capital classification. They are not produced by NEOS, they are produced by the fund's accounting team at US Bank and published as a requirement of the SEC. They are estimates based on book basis accounting, and they are not the same as the actual 1099 documents that are finalized in late January or early February. Using the 19A1 notice for tax reporting purposes is a mistake. The actual return of capital percentage for any given year is not known until the full review of all realized trading activity for the year. Tax treatment should be confirmed annually with a qualified tax professional using the actual 1099 rather than estimated from the monthly 19A1 notices. Now let us talk about how thoughtful investors are actually incorporating the boosted series into their portfolios. Troy describes a pattern that has emerged among sophisticated investors. Rather than selling their core SPYI or QQQI positions and rotating into XSPI or XQQI, they are keeping their core positions intact and using the monthly distribution income those core positions generate to fund smaller supplemental allocations into the boosted series. This approach creates a natural and disciplined mechanism for expressing a more aggressive market view. You keep the stability and income consistency of the core products as the anchor while deploying a portion of the income to take a more leveraged position. You are effectively using the market's own payments to you to fund your more aggressive bet on the market. The expense ratio conversation is one that always comes up. The core SPYI and QQQI charge 68 basis points annually. The boosted XSPI and XQQI charge 98 basis points. The additional 30 basis points reflects the genuine additional complexity of running these products at an institutional standard. For what investors receive in return, 1.5 times long exposure, a rules-based dynamic covered call income overlay, monthly distributions targeting 15 to 18%, 12.56 tax efficiency, and return of capital potential, 98 basis points represents reasonable value relative to the alternatives. The comparison is to the full package of what you would need to replicate this exposure independently, which would cost significantly more in complexity, trading costs, and tax drag. The most important thing to carry away is a clear and honest understanding of who these products are built for. XSPI and XQQI are not appropriate for every income investor. They are not the right choice for conservative investors who need maximum stability. But for investors who have a genuine multi-year bullish conviction, who want to participate more aggressively in upward markets while generating meaningful monthly income, the case for XSPI and XQQI is genuinely compelling. Drop a comment below telling us whether you are already holding XSPI or XQQI, or whether you are considering adding the boosted series. Hit the like button if this breakdown helped you and subscribe so you never miss a deep dive here at the Dividend Desk. We will see you at the next one.